In this video, we will take a look at notes receivable. Notes receivable is an extension of accounts receivable, or sometimes it could be a cash loan. It's basically money that is owed to us by an individual or by a company that we've sold merchandise to, for example. And if it goes beyond the standard 30 days to receive payment, then we can start charging interest on it, and it becomes a notes receivable. Just like if you don't pay your utility bill off by the due date, it becomes a notes receivable to the utility company, and they will charge you interest. That will be interest revenue to them. In a later chapter, we will deal with notes payable. But for now, terms we need to be familiar with is a payee is the person who gets the money. Maker is the person in debt. Maturity value is the principal of the note plus the interest revenue. And maturity date or due date is the date the note is due. So as mentioned a moment ago, if a customer cannot pay off their accounts receivable, or it sometimes could be a cash loan, then a note receivable is issued with a due date and interest rate. Assume a customer wants to extend their accounts receivable of $2,500 that they owe us for another 90 days. We agree to it, but we're going to charge them 10% interest. But we do not record the interest until the note is paid. To journalize the issuance of the note, we are just moving it out of accounts receivable and into notes receivable. These are both assets. So we will move it into notes receivable by debiting notes receivable for $2,500 and crediting accounts receivable for $2,500. Now, when the note becomes due 90 days later, we will record receiving the payment for the note plus the interest revenue. Now, since this is shorter than 1 year, it's just 90 days, the interest rate of 10%, that is quoted for a year. So, therefore, we will have to take 90 divided by 365 first, since there are 365 days in a year. We will then take it times the principal of $2,500, and then take it times the interest rate of 10%. I'm rounding it to the nearest penny here. That means $61.64 is owed to us in interest. Therefore, when the customer pays the note plus the interest, we will debit cash for $2,561.64. That's the amount of the principal of the note plus the interest revenue. I will take it out of notes receivable by crediting notes receivable for $2,500. And I've earned some additional revenue, so I will credit interest revenue for $61.64. Now that's great when the note is paid and paid in time. But sometimes, even if we extend an account receivable, that doesn't mean that notes receivable is going to get paid. If that's the case, we call it a dishonored notes receivable. A dishonored notes receivable is when a note becomes due, but the customer has not paid the amount. So a couple things could happen. It could be charged back to the customer's accounts receivable for the principal plus the amount of interest revenue that's due, and then we can hope to collect it from there. A notes receivable, though, is never written off. It's moved back into accounts receivable, and if we do never receive the money, at that point we can write it off like in the previous video. Now, once it's back in accounts receivable, the company will try and collect it or make a decision to write it off. Another option is sometimes a customer may ask for more time. They may ask for a new notes receivable to extend the time they get to pay us. However, they're becoming a bigger risk, so therefore, it usually comes with a higher interest rate. So we're going to look at both options here. Option 1, the customer takes out a new notes receivable. Let's assume that John Smith owes us $1,000 and at this point $25 in interest. He has asked for an additional 30 days to pay that notes receivable, and we've agreed to it at 10% interest. So what we have to do first of all is debit and credit notes receivable. I know that seems strange, but what we are doing is debiting notes receivable for the new note of $1,000 and crediting note receivable for the old note of $1,000, taking it out. We're going to assume that John does pay us the interest today, so I also debit cash for $25 and credit interest revenue. So now John has taken out a new note for $1,000 for 30 days at 10%. Let's assume after 30 days, John does end up paying us. So therefore, we will have to calculate the additional interest. It's for 30 days. So on your calculator, take 30 divided by 365 first, then multiply it by the principal of 1,000, then multiply it by the interest rate of 10%. I took it to the nearest cent, so $8.22 of additional interest revenue. Be sure and take the number of days divided by 365 first to get the most accurate number. Therefore, I will debit cash for $1,008.22, the principal plus the interest. I will credit note receivable for $1,000 and credit interest revenue for $8.22. Now for scenario number 2. What if the note receivable becomes due and the customer never ends up paying it? Let's assume we have $1,000 in note receivable from John Smith, and he did not pay us that amount plus the accumulated interest revenue of $25, nor did he take out a new note receivable. We want to try and collect that immediately. So what we do is we move it out of note receivable and back into account receivable for the principal plus the interest revenue. So what I would do is I would debit account receivable for $1,025, the interest plus the principal, credit note receivable for $1,000, and credit interest revenue for $25. Now at this point, we still hope to collect that $1,025. And we can continue to charge him additional interest as long as we don't end up writing it off. So let's assume there are two options that can happen from here. The customer can end up paying it, or we can end up writing it off. So let's assume that the customer does end up paying it, okay, and they end up paying it an additional 30 days later, and we're charging them 8% interest. Now the principal does now become that $1,025 because that's the amount they owe us in accounts receivable. So they pay us another 30 days later. So I will first take 30 divided by 365 in my calculator, times 0.08 for the interest, times 1,025 for the principal. They owe us an additional $6.74 in interest revenue. I add that to the 1,025, and if they do pay us, we will receive in cash $1,031.74. We will take the $1,025 out of account receivable and record the $6.74 as interest revenue. Now, the other option is it would be unfortunate, but the customer doesn't end up paying us. Maybe they've gone out of business, so we've decided to write it off. Therefore, you can go back to the previous video. You could write it off using the allowance method. And again, the amount in accounts receivable is $1,025, so that's the amount we will write off. At this point, since we're writing it off, we cannot charge any additional interest. So if we're using the allowance method, I will debit allowance for doubtful accounts for $1,025 and credit accounts receivable for $1,025. Or the direct write-off method, I would debit bad debt expense for $1,025 and credit accounts receivable for $1,025.